Good day, everybody. Brian here. I want to show you the U.S. markets comparing the overall uh, benchmark we'll use is QQQ, and I'm going to show you the different ways to look at the markets via ETFs that specialize in these various data types or analysis types when it comes to trading. This is all 100% purely focused on the U.S., and we're going to take a look at some of the different ways and just show you how subpar everything is right now. So right now you're looking at the transportation uh, section or segment of the U.S. economy based upon ETF performance. So in blue is that's the focus based upon those basket ETFs that are performing with a positive return over the last year. And then we also have the standard benchmark of the QQQs in yellow. All right, so what I'm going to show you right now, as you can see, reason I'm using transportation, it's very important to understand this would include companies like courier companies, trucking companies. That's a very, really good leading indicator to look at to see how the overall US economy is doing. Okay. And that will tell you uh, of the future glimpse of where things are at. And right now, I'm gonna try to educate you. This yellow line is fakery based upon skewness of the big tech. As an example, the Nasdaq is up over 1% because of one stock called Nasdaq or it's called Nvidia. So it really skews what the markets really look like. And you can see here it's fairly range bound for transportation. But if I move over here to something like, let me see if I can find the tech. Um, Okay, so tech here is really important to understand. You can see that this is a fairly similar indicator of what I'm talking about. You can see here in yellow, the QQQs are positive, but yet when you look at the tech players, ETFs, they're fairly in line with uh, the QQQs. And then all of a sudden they'll outperform for a little while, and that's because of the returns and the quarterly calls of companies like Apple, Microsoft, Google, and just lately Nvidia. And you can see here it dips back down. So this period right here of where it outperforms is because of quarterly calls from these companies. And look what happens, it drifts back down. So a lot of the performance you're seeing in the US stock market, similar to the QQQs, is driven by big tech. I just mentioned some of the companies. You can see here that the ratio, the Sharpe ratio is okay. You want to see that at over one. But when you look at the annual or monthly returns here of what's been going on, you can see here how volatile all of last year was for 2022. Pretty good July, very weak August, September, and it kind of bounced back October, November, and then it drastically dropped back in December. So here it's been fairly stable, but you can see lately it's been weak for April, May. Okay, that's because of the debt negotiate, all the bad news of what's going on in the States and in the economy of the US. So this just shows you uh, you're getting okay returns with these companies and with this sector, but moving into next year, later on the year, as the economy may continue to deteriorate, you may not get continued performance here. Like when you're seeing negative performance for February and April, that's not a good thing. I mean, you can ride it out if you get a good return in the month, but you're still should have these kind of periods of deep drawdown and excessive up moves. If you want my opinion right now, tech is okay to be in, but you want to be in something a little more stable. When you look at the Sharpe ratio, if I just reported on crypto, just Litecoin alone, you would have got better performance over the last year. Just holding Litecoin versus all these other uh, assets and trying to beat this and beat that. So it's kind of important to see this from a big picture and to see it visually. Okay. But this month it's doing okay. Okay. All right. So let's move over to now the different styles. So we have here growth. Growth is outperforming the the standard benchmark of the Qs. Actually, in fact, of all the different tear sheets I've looked at, this is the best performing. And you can see here, it's been pretty good. So there's certain growth related ETFs that are doing pretty good. Okay. That's what you want to hold. Okay. Drawdowns are nowhere as bad as they could be. Um, not as strong. And again, I'll have a master portfolio analyzer in this service I'm launching. But I just want to educate you on what to look for to get better return with less volatile, crazy drawdowns that you would have got with tech last year. Will it continue moving forward? I don't think so. If the markets do drop, you don't want to be in those markets. That's moving forward as of May 25th this year. Here's another one. Now, momentum. I talked about momentum is the most lucrative way to trade. Boy, that blew up on Twitter. So when you look at this year, again, the cues, they're so distorted because of big tech. I have one here of NASDAQ. You'll see how similar it is. But here, the cues are easily decimating the the momentum stocks, only 0.28. Do you really want to hold those? Here, look at this comparison between the tech and the momentum based stock. So momentum is definitely something not happening in the stock market in the US. You're getting measly returns, but the drawdowns are not so bad. Here it's not so bad, but still you want to place your order you want to place your capital in better performing sectors. Now let me see if I can find the Nasdaq. Uh, let's see here. There we go. So you can see here, Nasdaq, because of the big tech, is easily outperforming the Qs. But look at that. That's still outperforming out of everything I've seen so far with a Sharpe ratio of 0.61. So we're doing well there. And it's all started since this year. So just putting money into Nasdaq might be a better bet than the other indices like the Qs, the Dow Jones, or the S&P, or the Russell. And again, let's see how it's done overall. Where just for this year, you can see it's a slight edge with Nasdaq over the Qs. Um, Here's what really matters right here. Okay. So you can see here it's starting to putter out the returns for April, May. And you can see they're negative February. But if you were in January, which was really good, you had done well. And again, this is all NASDAQ. Okay. So we've looked at momentum, right? This is not so great. NASDAQ did pretty good. That's actually the best performing. But when you look at the value based ETFs, they're still getting crushed too by the NASDAQ and the big tech. The Sharpe ratio is fairly weak. And look, it's just killing the value based ETFs. Here, again, you could probably hold Treasury and do better, funny enough. All right, so there's that. So we have the Nasdaq. I've shown you. We've shown you the tech. Okay, so we've looked at the transports, but look at this. If you focused on shorting ETFs, you would have done better. Look at that. Look at that. So that's where the money's being made are in the shorting bearish ETFs. Probably I wouldn't be surprised there's some leverage ETFs in there as well. Again, this is all part of my membership. right? That I'm going to be launching. I mean, it's kind of affordable what you want. Look, if you join here, quantlabs.net/books, opt in, you'll learn more about this. But again, take a look at this. You got the shorts outperforming and just killing off everything. That's also including the crypto. And the question is this safe? If you watch it every day and look for these charts, yes, it's very safe. Once you start to see them weaken, then you might want to uh, recalibrate, meaning reposition your ETFs. So you can see here, you're getting double the return than of the QQQs. That's pretty crazy. That's another factor that you need to understand, that the big tech, the NASDAQ, maybe 10 companies, they're skewing the market. This is the real economy, what's going on. Many, 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 in thousands upon thousands of stocks. ETFs are pulling still negative returns. But on the flip side, when you short them, you focus on those that are leveraged, you can make some good money with those particular ETFs. But of course, the weaklings in the government in Washington are talking about banning shorting. They did that in 2008, 2009. It's just their way of saying we don't believe in democracy because we don't want the smart people that know about shorting to make money at it. Boo hoo hoo. But here on the monthly returns has been very good. Absolutely amazing. Okay, so don't be fooled with what you read, what you see, what you hear. Okay, this is your best sector in the shorting ETFs, the bearish ETFs. Look at that, 45% return. That's strong. 1.82 Sharpe ratio. All right. So that's why I'm here to educate you on this. I just put one up on gold. It's not what you think it is. Okay. And a lot of these ETFs can be manipulated. But regardless of the manipulation, whichever one gives you the best return, you can't avoid it. Even look at last year, except for October, you would have done very, very well just shorting this basket, holding these set of ETFs for last year. You would have done very well. Very, very well. Anyways, we'll leave it at that. Again, if you want to know more, you got to go over to quantlabs.net/books to learn more. We do have an affordable service for this, and I'll probably put up a follow-up course on this. All right, we'll leave it at that. Thanks for watching. Make sure you go to quantlabs.net/books to learn more and opt in. Over now.